Welcome to the Numbers Game. I'm Jace, and I'm here with Nick and Marty. How are we going today, fellas?
Going well, Jace, on what has no doubt been one of the most challenging years in business that I've ever seen in the history of business. I'm alive and I'm well, and I get to fight another day, and things are actually looking up. So feeling good. I think that's a great test of character when you can go through more challenging years and come out the other side and have real optimism. So yeah, I hope that's the case for a lot of our listeners as well, and they've handled the intricacies well. Nick, how are you, my friend?
Oh, mate, I'm good. Yeah, it's been a busy year, and end of financial year is crazy for us. Obviously, not as crazy as what Jace would be experiencing, but it's there's not much time left for people to get their super contributions in, so we're very busy with that stuff. But another year down, 16 years at Innovate. 2007 we started in July, so that's 16 years, right? So yeah, so getting old, mate, and 16 years in is a bloody long time, isn't it? But we're ready to go again and looking forward to the next vineyard.
How you going, Chase?
Teenage years, 16. Wowee. Happy birthday to Innovate for in a couple of weeks. That's very exciting. Guys, I'm good. I'm up on the sunny coast. We've got a team member up here, and fortunately also mixing with some of the Innovate team members up on the sunny coast in the Mooloolaba office. It's really difficult when you get up in the morning to 17 degrees and sunny and go for a jog along the beach. We're here in the moment, Greg and I. We have the Gold Coast Marathon next weekend. We're recording a little bit early. That when this episode goes out, the Gold Coast Marathon would have been yesterday. So hopefully Greg and I are alive and well, and we survived the marathon. Greg's primed, ready to go. He's nearly on his 1,000th day straight running. So we definitely wish Greggy all the best for his target time of 3 hours so he can qualify for the Boston Marathon. My target time is survival, just getting to that finish line.
Well, I'm glad you're doing it tough there with 17 degrees in the morning. The dog had to go out this morning to do what it needed to do, and I didn't put a coat on, and I was certainly encouraging it to hurry up because it was pretty freezing. So glad you're happy, mate.
Yeah, nah.
How do you like the office up there, Jace? It's somewhere you can see yourself long term?
Yes, mate. I think pretty much ready to sign the lease if you've got it prepared and ready to go for me. It's we fit in nicely. Greg's already found the nearest place to get hot chips. Tave has found the nearest place for sushi, and then they also found the Boost Juice and the coffee shop. So I mean, all of the main supplies that are needed for an accountant to keep themselves busy all day. I think Aaron thought Greg was a bit of a toddler or a child when he said he had to get some hot chippies for lunch. We all had a good laugh, and Aaron was cacking himself. So no, it's good, mate. It's good. Really enjoy it up here, and hopefully we can send some of our team members up here to rotate through the office and create a bit of a good culture with a few of the team members up here, as we do like to have people get to know each other even more and spend time together. So not a bad place to send the Melbourne team members during winter as I look out to the ocean and the sun. And anyway, I said I wouldn't talk about it. But guys, exciting episode today for me because, I mean, I love all things tax and accounting. And at this point in time, this is going live, this episode. It's July. It's the new financial year. It's the 23-24 year. And we have had bookings coming in hard and fast for people to get their individual tax returns done. And we've also got business owners booking in to make plans and reset their goals for the 24 financial year. So we kind of getting hit, at all times. And I remember starting, actually, before I get into story time, this episode's brought to you by Future Advisory, given that it's all things tax this episode. If you do want to discuss with a great accountant or business advisor anything about your personal finances or your life around tax and business, futureadvisory.com.au would be more than happy to help you out and get you on the right path and get your future looking rock solid. Now, I was going to say, when I first started in the accounting industry, I always had people say to me like, oh, outside of tax time after July, August, September, you must be pretty quiet, right? Like it's not that busy. And knowing what happened in accounting land, I was like, oh yeah, actually, that's a good question. I wonder what our firm does. And, 10 years on, from being in the industry and building a career and starting a business, I actually don't know if there is a quiet time in accounting, between individual tax returns, BASs, people wanting stuff done before Christmas, the new calendar year starts. Then you got BASs, fringe benefits tax, tax planning, dividends, Section 100A, family trusts, all of it. So it's crazy. And just when you think there's not enough to deal with, the ATO releases their top things they're cracking down on for 2023 year for all the lodgements. So I thought it'd be worthwhile sharing with you guys and our audience and listeners the things that the ATO are on the warpath for, and then also some of the changes that you're going to have to face when you do go to lodge your tax return this year. So I'll crack in for the first one and the biggest one. It is rental property owners. Just when rental property owners have not copped enough of like 11 rate rises and costs going through the roof, and potentially property tenants that are unhappy with some small rent increases to try and cover some of the out of pockets, the ATO has now come along and said that rental property owners and people that Airbnb or stays their main residence as well are in the top of the firing line for the ATO. Now, some of the reasons behind this is of all the rental property tax returns or the tax returns with rental properties on it that the ATO go through, 9 out of 10 properties are reported incorrectly. So if you've got one property per person, there's 9 out of 10 tax returns being lodged with the property on it are incorrect. So the ATO has just gone, enough's enough. We've got to get serious in targeting this area. They do expect to be able to pick up, close to $100 million of extra tax revenue from getting this right, and then as much as $500 million in the coming years. And the ATO were given an extra $90 million in the most recent budget to be able to chase compliance in areas like this. Now, when it comes to the incorrect reporting, one of the biggest ones that rental property owners are incorrectly reporting is the interest on their home loan. Now, so we know that it's only the interest component that is tax deductible and only the interest component that relates to the portion of that property that is being used to generate income. Now, so of course, if you're also using, let's say you've got a property down the coast and you go and use that property on weekends, or you block it out over Christmas and New Year and you have the family retreat down there, you've got to prorata that interest and those expenses on the property to not be tax deductible. So the ATO is figuring out there's a lot of people that are, double dipping on using the property and also claiming the deductions too. Further to that, and I'll give you guys a chance to chime in at some point soon, how excited I get about tax. 17 of the largest lenders in the country are giving the ATO the data that they need to be able to cross-reference this. So if you've got a home loan with one of the majors, chances are the ATO knows exactly what the interest cost was on your home loan. And if you claim $1 more on your tax return, they're going to be going, where did that extra dollar come from? You've now got a red flag against your name, and we are coming for you.
They're obviously not with Future Advisory. That's my first
Correct.
point of call. But I gather these are just people doing their own tax returns.
You would absolutely think that, Marty, and I'm glad you said it. In fact, 87% of rental property owners use a tax agent to do their tax return.
Kidding me.
And
there's
it's
that big a discrepancy. Well, that makes me think then the reporting system's failing on the ATO side too. Like it could be a two-way street here, couldn't it?
100%, Marty. And I think as well where it can fall down is tax agents under a lot of time pressure to keep the appointments going. Yeah. Getting a tax return lodged is not a sexy thing. It's not something that a lot of accounting firms charge the correct fees for or enough fees to cover. We've had to put our fees up year on year to make sure we had the time, the budget, review the paperwork, request the documents, and then we've got a senior employee with 15 to 20 years experience who just reviews tax returns and lodgements to make sure things are correct. Now, that's a lot of cost out of our pocket to have all these double, triple checks to make sure something as simple as a personal tax return is filed correctly. And we're human. Every now and then you'll still get one that slips through to the keeper with some errors on it, and we work our bloody butts off to make sure that doesn't happen, and we fix it when it does. But you can imagine some smaller firms or some firms with budget constraints or inexperienced team members. You got to remember that so there's some places out there, I won't say it, it rhymes with H&R Rock. They, for example, don't have qualified accountants working to do the tax returns. Somebody will do the interview with you, punch the numbers into a tax return, and then somebody with the license will sit in the back, kind of review it and punch it through. And that's not to say they're the ones getting it wrong. I'm sure they've got many fantastic people lodging tax returns correctly, but overall, the mistakes also can come from not doing that extra bit of due diligence to make sure your client is keeping the correct paperwork. Or, if we said to a client, how much interest did you pay on that property? And they reel off a number, between our relationship with the client is the client signs the tax return. And it's not good enough to say, as far as we're concerned, it's not good enough to say that, oh, well, the client gave us the wrong number and they signed the tax return, so it's their fault. You got to ask the right questions and push further, and then ask for the documentation to be filed with that tax return to know that it's correct. So yeah, unfortunately, 9 out of 10 properties are wrong, and 87% of them are using a tax agent. So my warning beyond that to somebody listening who goes, shit, I do use an accountant, it is to make sure you've checked your numbers. When you provide it to your accountant, you checked. And when your accountant sends you that tax return to sign, please double check everything is entered in correctly, because your accountant's human and sometimes they will make mistakes too. But at the end of the day, if the ATO reviews your tax return and it's wrong, it's you who gets in trouble, not your accountant. So that's the big warning there.
Did you say with the interest, the main issue was people actually living in the property and claiming it, or are they claiming more than the interest component? Did you say that?
Bit of everything.
Okay.
Yeah. So as well. So what happens as well, Nick? Sometimes, let's say you might see somebody with an investment property has paid down the loan. They get some equity in the property and they redraw some funds back out of their redraw facility. Yeah. Now, let's say that loan was paid down. So let's say only 80% of the value of that loan was now tax deductible against the property. Yep. That person redrew money back out and buys a car.
Yep.
But they kept on claiming the interest on the property. Yep. So this is what the ATO's got all that data, and it's just, and that's one example.
I couldn't tell you how many times as a mortgage broker, people would call and ask to increase the debt on their investment property because they had equity, and they're going to use that money to pay their home down because that money was tax deductible. So people genuinely do believe that if it's secured against the investment property, it's tax deductible, and we always talk about what was the purpose of that money. So that doesn't surprise me.
It happens the other way too, Nick, where people feel like when they're drawing money out of their home loan for investment or setting up a new facility against their primary place of residence, that they feel that that's not tax deductible because it's against the home. It's the purpose of funds that matter.
Yep.
And the other thing is, so you've got a situation there, Jace, where potentially people might be making principal and interest repayments and claiming the whole lot instead of just the interest component. Is that it?
That's also, definitely. That's definitely where some people get confused because they're just seeing that money suck out of their account. Yeah. And sometimes that loan might have changed partway through owning that investment property where it's gone from the honeymoon period of interest only. It's flicked over to principal and interest. And at the end of the year, they've just told their accountant a figure that's punched into the tax return, or they've punched it in themselves, not realizing that there was principal involved in those repayments. So
genuine lack of understanding.
Yeah, correct. And beyond that, there's also the other claims like repairs and maintenance. Now, sometimes repairs and maintenance is actually capital improvements. And instead of claiming, a $5,000 repair because you've ripped up the old deck and put in a new deck and you've called it a repair, but realistically, that deck you've installed was Merbau timber and it had a roof on it, whereas the old deck was, pine and had no roof. So realistically, that's a capital improvement, not a repair. So these are the kind of areas where it's really easy to come undone if you don't have the overall knowledge. So if you're, so that's that one. And the other one, just before we move on to the couple of others, is people who are using Airbnb or stays, and they've got their property, they're renting it out on Airbnb or short-term holiday rentals, but not keeping enough data around when it was available, when it wasn't available, and actually pro-ratering the cost to say, well, I took that property off the market for 100 days of the year out of 365. I've got to pro-rata my cost to not claim extra deductions where I was using the property as a holiday home. So that's one of the big ones.
100 million seems like a lot. And I get there's a lot of people that have investment properties out there, but 100 million is a real surprise to me because I go back to Marty's first comment, or maybe it was your comment. Isn't enough? We're already driving people out of the decision to invest because every time you try and get ahead in this country, you get you get tapped back down, or you get smacked back down. So there's a rental crisis. We don't have enough properties, which I think the government's got a lot to answer for. There's a lot of landlords selling their properties because it's just too hard to own one anymore and too expensive. And now they want to tax those people that are investors again, which is going to be more reason to sell it and just increases the rental issue. Surely there's bigger fish to fry.
Well, no doubt they'd be backtracking. They'd be backtracking those results for a number of years. It won't be just last year's, won't it?
Yeah,
So-
it'll be recouping across the board, and that's their estimates over the next 5 years as well. So, one of the
Jeez.
articles went along to say that the expected increase in revenue received due to these measures is an extra 474.9 million in additional receipted income, due to the 89 million that's been given to the ATO to further buffer the compliance program, a compliance program against personal individual tax returns. So personal income tax, that's where they expect to get close to $500 million in additional receipts by getting this done properly and making sure people are paying the appropriate and correct amount of tax. So that's that one. So rental property deductions, been over that. Everyone knows now. Tell your friends. Anyone got a investment property, send them a link to this episode. The next one beyond that, and it's kind of somewhat related, is around capital gains tax. So again, the ATO with data matching and the data they get from everyone is getting way more data than ever before. We hear it every year, but if you buy or sell shares, the ATO knows about it. A lot of cryptocurrency exchanges also tell the ATO about you buying or selling cryptocurrency, and then also properties. If you've bought or sold a property, if you've transacted a piece of land, all of this data goes to the ATO. So then also what you need to keep in mind is you might be living in that property when you sell it, but you've got to think, if you've had it for a long time, did you rent it out at some point in time? Because a lot of people are, somewhat potentially conveniently or somewhat not conveniently, but they're forgetting that their property they now live in used to be a rental property at one point in time, 5, 10, 15, 20 years ago. So the ATO is kind of catching up on people who thought they were claiming the main residence exemption, but they were double dipping on another main residence somewhere else. So capital gains tax is another big one. If you lodge your tax return in a hurry, you forget that you sold a parcel of shares or transacted on something on your capital account, the ATO will eventually be coming after you for your CGT schedule, so you can report the gain or loss on your shares, managed investments, crypto or property transactions. So probably not a huge amount of further to go into for that one, but obviously with what you guys do on the financial planning side, Nick, you've got people with share portfolios, managed funds. Marty, your brokers will be dealing with people with investment properties. So this is all relevant to them, that capital gains tax. And I've been guilty of it myself. I'm in the game. I'm an accountant. And I remember, in my earlier years, I wanted to get my tax return in. I wanted my refund. And it wasn't until a couple of weeks after my refund landed in my account, I went, hang on a minute. I sold a parcel of shares that I forgot to report. Shit, like it's gonna put a flag on my name. I better amend my tax return myself before the ATO finds out. So it's easy to do. So the warning there is, before you rush to do your tax return because you want that refund, stop, take account, look back through the whole year, check your bank account, check all your transactions, because you may find something in that you did, 11 months ago that you forgot about, and you need to report that. So CGT boys, anything to add there?
Yeah, and I think the only other thing I'd say is just make sure you've got a system around that. If you are trading shares, and shares is the biggest one, shares or crypto, you don't want to get to the end of the year and go, oh, what did I do this year again? You should have some sort of system where you're making a trade, or you're buying, or whatever it might be, buying or selling, so making any kind of trade, that you're actually keeping a record of that. So you get to the end of the financial year, you can see it all. Firstly, because number one is it's a job you don't want to do at tax time. So if you don't have all the information readily available, you're going to keep putting it off. And number two, you want to make sure that you're getting it right. So it's really simple just to note down what you bought for, what you sold for, and the date. Yeah. Then you can just hand it all to your accountant, and you don't have to go scrummaging through it.
Do it every quarter. Like I do it every quarter. It depends how active you are on it. But again, a lot of those providers like Stake and even the major bank platforms will allow you to consolidate those buys and sells pretty easily that you send through to your accountant. So just get into a habit depending on how active you are.
And look, it doesn't have to be
It's
anything
good advice.
sophisticated. I mean, I had for years and still do it somewhat to this date. Like, so for the last 12 months, what I did was anytime I made a donation and got a receipt or sold a parcel of shares, I would re-forward the email to myself, but I'd change the subject line to tax 2023 dash donation, tax 2023 dash share sale. So then when it comes to tax time, all I do is on a separate screen, I go to my emails and I type tax 2023, enter. Boom. There's everything that I've got record of because I'm horrible at keeping a physical receipt. So it's got to be digital for me. Even if I take a photo of it and email it to myself and call it tax 2023. It's look, that's not a sexy or complicated system, but it works. I mean, it keeps everything in the one place and it's digital and it doesn't go anywhere unless you lose the password to your emails or you get hacked. But anyway, that's a problem for another day. Rounding out, guys, on the final thing the ATO are focusing on, and this one's actually quite big if you haven't paid attention. It's quite big if you rock up to your accountant and just expect your tax return to be easy again this year. So there's some big changes around, well, there's a big focus on work-related expenses for starters, and then there's more of a focus around working from home and your home office expenses. We've talked about it many times on these apps before about kind of the drive to get people back in the office, and the ATO is not stupid either. They know a lot of people have gone back to the office more so than working from home. So what they are expecting to see is a decrease in working from home expenses, the personal mobile phone use, the personal internet use, and those home office claims where you were getting the shortcut method claiming 80 cents per hour potentially, and then all the other bits and pieces for home office expenses and whatnot. Now, when it comes to your work-related expenses, the ATO is going to be data matching what you claimed last year next to what you claimed this year. If you're copying and pasting the same number, you're in strife. ATO's got the flag against you, ready to go and ask you to prove that's correct. So you've got to make sure it's not just a copy paste. If it is copy paste because it's exactly the same scenario, 22 versus 23, be ready to have your records on standby to be showing that to an ATO reviewer or auditor because they're the first people that they're going to be targeting. Beyond that, come the 1st of March 2023 just gone, the ATO changed the rules around claiming your home office hours. You must now keep a record of every hour you worked from home every single day for the whole year from March 1st onwards. So we used to be able to say to a client, hey, on average, on a 12-week or whatever kind of, given timeline, how many days would you average working from home? And people go, I work 2 days a week from home. You go, cool, you do 7 hours a day, 8 hours a day, yep, sweet, whatever. And you do 2 days, 8 hours, map it out over the year, minus off some annual leave and some Christmas, and easy, good to go. ATO now says, nope, not good enough. You will keep a record of every hour you work from home, and you have to have it structured in a diary with every single day of the week where you punch in your start time and your finish time and anything else around that if there is any varying hours. So I think, look, realistically, they're trying to make it a lot harder for you to claim those home office hours and you've got to prove that it was real. You've then got to go and have calendar entries and proof that you were working from home at that time.
Chase,
Yeah, mate.
When did they say this was? When did this come out?
3 months ago, 1st of March 2023. So not only to make it more complicated for everyone, they've done it part way through a tax year.
I'm just going, why would they not have done that at the start of the financial year to prep everyone to do that? I mean, this is the stupidity of it. Like, you leave it late in the piece. Now people got to go back 9 months without having any basis upon that being, now a new way that they're going to operate. I don't understand it.
So pre-March, you can use one of the older methods, but March onwards, you've got to actually
from March.
From March 1st, you've got to keep this diary.
Well, that makes sense.
So then keeping those records. Beyond that, they've also increased I'm trying to find the rate. I think it's gone up to, I'm not even going to pretend. 67 cents is the rate now. So during COVID, you had the 52-cent method, and then you had per hour to claim home office. And then on the 52-cent method, you could claim a little bit for your mobile on top, a little bit for your internet on top, some depreciation, some printing and stationery. You claimed it all. During COVID, they went, okay, a lot of people are working from home. Let's give them a flat 80-cent rate, but they can't claim anything else. They just work out how many hours they worked from home, and they get 80 cents per hour. They've ripped that away from us now, so you don't get the simple shortcut method of 80 cents. They've taken it back to 67 cents, but the cheeky buggers have now incorporated your mobile phone, your internet, electricity and gas, computer consumables, and stationery are now all wrapped up in that 67 cents. So again, another common mistake we'll probably see people make is they'll want the 67 cents per hour for working from home, and then they'll probably add their mobile phone, their internet, and their stationery on top of that, which is where the ATO is going to get that data and go, big no-no. So yeah, look, heaps going on. There's heaps more stuff I'm going to. Just as like little dot points for you. Study, if you're claiming study expenses, you used to have to wipe the first $250. It was non-deductible. They've got rid of that. So if you're paying for study that's related to your job, you can claim the whole lot now. You don't wipe the $250. You're claiming a motor vehicle. It's gone from 72 cents per kilometre to 78 cents per kilometre. So you're getting a little bit extra bang for your buck on your fuel claim, as long as you've kept your diary to justify your kilometres.
It's a great incentive to get back into the office. You get more on your travel allowance, and you're getting stiffed on your work from home allowance. Okay.
But be careful from home to the office. Home to the office is not tax deductible unless given special circumstances.
Well, you got to go to a client first, apparently.
Oh, geez, Marty, we're getting into some funny territory here. This is not advice from Future Advisory. No, just kidding. No. So look, but this is where it's important to have a great relationship with your advisor and your accountant. Learn the tricks of the trade or the genuine rules so that you can be safe and get the right amount back. And the biggest warning to everybody out there who's about to lodge their 2023 tax return, be kind to your accountant this year. It's not their fault, but the ATO over 2021 and 2022, they had what was called a low middle income tax offset. The accountants had this up our sleeve. So for the last 2 years, most clients got an extra $1,500 in their refund. Now, people have short memories, so they're used to, they habit, the routine has built that if you and your partner were getting $2,000 to $3,000 refunds each, and you're getting a tax time going, you beauty, that's going to halve this year. You're going to get, as a couple that are earning, anywhere from 60 to 120 each, you're going to lose $3,000 out of your refunds this year. It's not your accountant's fault. They didn't do anything wrong. They didn't claim less than last year. I mean, unless you genuinely didn't spend any money. It is simply the low middle income tax offset has been removed by the government and the ATO, so you do not get that extra $1,500 back in your refund, and it's been taxed week to week, paycheck to paycheck. You've paid more tax during the year, and you're not getting that back in your refund. So that is probably the biggest warning out there. Greg and I were talking about it the other day, just going, this is going to be one of the worst tax times for tax agents and accountants out there, because people come in, they're amped, they're getting their, holiday spending money, they're getting their rego refund so they can pay some bills. Inflation's been rough on people, rates have gone up, costs have gone up, and instead of us getting to be, here's a big whopping refund because you've got that low middle income tax offset, this year we're saying, you might get $500 back when you used to get $2,000. And that's going to sting some people who are sitting there waiting for this refund to help them at the moment with cost of living. So huge apologies for the bearer of bad news, but yeah, there's a lot of people who are going to be left a bit stiff and a bit short on their usual refunds this year.
Jace, do you have the stats on how much the ATO would save by simplifying the system? Seriously,
I think.
What a dead set joke! Like.
It's nuts.
Imagine how much time and money they spend on coming up with the tax system. It's, Marty's got to, I think both of you guys have it sorted. Marty, just a flat tax rate and then increase the GST. Simple. Not this work from home and how much of you, how many hours you have your heater on.
Anyone supposed to know what's going on?
And then to come back and, and granted, there are people taking advantage, 100%. I understand that. But how many people just it's a minefield, to work out what you can and can't claim. And then the reality is you guys got to charge more to do it. So you charge the client more because you've got to work through it yourself. So you got to increase your prices. Anyway.
Absolutely. Look, yes, it keeps me in a job. Could it be simpler? Bloody oath. It is an absolute nightmare. I'm glad we're there for our clients to try and guide them through this because, and look, a lot of people every year when we generally try and coach and educate our clients while we're on the phone for half an hour and we talk them through a few of these, and most clients sit there going, how do you keep up with all the changes every year? Like, and we go, hey, look, it's a big part of what we do is we have to hit our CPD hours. We have to study. Every year we study and we keep learning. And, here we are again, another year, another bunch of changes, and not necessarily for the better, and more confusion, more mistakes.
We like to give money to charity, and I think maybe we could salary sacrifice to the tax office to help them out and, just bump up the coffers a bit through these challenging times. I just think it's... like you said, it's thank goodness for accountants like your good self, Jace, because it is a minefield out there. It doesn't need to be, but at the end of the day, it is what it is. As long as you're doing the right things and get the right advice. Again, have your accountant work with you closely to make sure you don't get caught up in the various loopholes that exist there.
That's it, mate. If you enjoyed this episode, or if you know someone who needs to hear all these things that the ATO is on the lookout for, like it, share it, subscribe, send it to some people that you know that will get some benefit. And until next time,
I'm just sending my shirt to the ATO. Game over.